The United Arab Emirates just announced that it is leaving OPEC after roughly 60 years of membership. Most people will look at that and think the story is about the Middle East. They will think it is about oil politics, production quotas, Saudi influence, or some internal fight among energy producers. But that is not the deeper story. The deeper story is about the dollar. When a country like the UAE begins to separate itself from an organization that has helped support the oil pricing system for decades, the right question is not only what happens to oil, the right question is what happens to the system that made the dollar the center of global trade after it stopped being backed by gold. That is the part most people miss. They see the headline, they do not see the machine behind the headline, and in markets the machine matters more than the headline. Let me start with something simple. If I hold up a $100 bill and ask you what it is worth, the easy answer is $100. But that answer is not really an answer. $100 is not a fixed amount of value. It is a claim on purchasing power, and purchasing power changes. $100 today does not buy what $100 bought 5 years ago. It certainly does not buy what $100 bought 50 years ago. So the real question is not what number is printed on the bill. The real question is what system gives that bill value. That question matters because money has gone through major transitions before. And when money changes form, most people notice only after the consequences have already arrived in their lives. Before 1971, the United States dollar was connected to gold. That did not mean the system was perfect. No monetary system is perfect. But it did mean there was a constraint. If the government wanted to spend far more than it had, it could not simply create unlimited dollars without eventually running into the gold constraint. Gold was the anchor. Gold was the thing that could not be printed. Then, on the 15th of August, 1971, President Richard Nixon suspended the convertibility of the dollar into gold. He called it temporary, but temporary has lasted more than half a century. That one decision changed the nature of the dollar. The dollar moved from being money backed by gold to being fiat currency backed by confidence. That distinction is extremely important. A fiat currency works because people believe it works. You can buy groceries with dollars because the grocer believes someone else will accept those dollars later. Businesses accept dollars because suppliers accept them. Foreign central banks hold dollars because other countries use dollars. The system functions because trust circulates with the currency. But if a currency is not backed by gold, it needs another source of demand. It needs another reason for the world to hold it. That is where the petrodollar system became so important. In 1974, after the oil shock had shaken the world, the United States made a strategic arrangement with Saudi Arabia. The arrangement was not a simple contract with an expiration date, the way people online often describe it. It was not a neat little 50-year agreement that suddenly ended on a particular day. The reality was more structural. The United States and Saudi Arabia built a system in which oil would be priced and traded primarily in dollars. Saudi Arabia would take a large share of its oil profits and recycle them back into United States financial assets, especially treasury securities. In exchange, the United States would provide military protection, weapons, and geopolitical support. That arrangement did something enormous. It created constant global demand for dollars. Every country needs energy. If oil is priced in dollars, then countries that want oil need access to dollars. That means they need dollar reserves. They need dollar-based banking relationships. They need a place to store surplus dollars. And where do many of those dollars go? Back into United States debt. That is why the petrodollar system mattered so much. It helped turn the dollar into the dominant reserve currency of the world after the dollar had been disconnected from gold. It allowed the United States to borrow more cheaply than it otherwise could. It helped the United States run large deficits without facing the same pressure a normal country would face. It created what economists sometimes call an exorbitant privilege. That privilege is not magic. It is a system. And all systems have mechanics. If you understand the mechanics, you can understand why certain events that look small on the surface can be very large underneath. For decades, this system ran quietly in the background. Most people did not know it existed. They went to work, they earned dollars, they saved dollars, they paid bills in dollars. They did not think about why the rest of the world needed dollars. They did not think about oil settlement, treasury recycling, reserve balances, or the connection between geopolitics and the purchasing power of their paycheck. But whether they understood it or not, they benefited from it. The dollar was not just America's currency. It was the world's working currency, and that made American life cheaper than it would have been otherwise. Imported goods were cheaper. Government borrowing was easier. Asset prices had a large global bid under them. The United States could print, borrow, spend, and still find buyers. That is a powerful position. but powerful positions can weaken slowly before they weaken suddenly. After the pandemic, the cracks became much more visible. In 2020, the United States government spent an enormous amount of money it did not have. Stimulus checks were sent out, unemployment programs were expanded, PPP loans were created, businesses were bailed out, markets were stabilized, households were supported. The purpose was to stop a depression, but the consequence was a massive expansion of money and debt. When a government can create currency, it can create dollars, but it cannot create wealth in the same way. This is the principle people must understand. Printing currency is not the same as creating wealth. If an economy produces more goods, better technology, more useful services, more productivity, then it has more real wealth. But if an economy simply creates more claims on the same goods and services, the claims become less valuable. That is inflation in simple terms. And when other countries watched the United States create trillions of dollars after 2020, many of them began to ask a very rational question. If our reserves are held in dollars, and the issuer of those dollars can expand supply at will, are we really holding a stable store of value? That question does not destroy a reserve currency overnight. The world does not change reserve systems in one day, but it does plant the seed of diversification. Then the Russia and Ukraine conflict accelerated the process after Russia invaded Ukraine. The United States and its allies froze large amounts of Russian reserves. Many people in the West looked at that and saw justice. Other countries looked at it and saw something else. They saw counterparty risk. They realized that reserves held in dollars or euros inside the Western financial system are not only financial assets, they are political assets. They can be frozen, they can be sanctioned, they can be blocked, they can be turned off by decisions made outside their own borders. Again, that does not mean those countries approved of Russia's actions. That is not the point. The point is that policymakers around the world learned a lesson about the architecture of reserves. If your wealth is stored in another country's currency and inside another country's financial rails, then your wealth depends on that country's willingness to let you use it. That is a major realization. Once that realization happens, central banks do what rational actors do. They diversify, they look for assets with no foreign political issuer, they look for assets that are not someone else's liability, they look for hard reserves. That is one reason gold became more important again. But before we get to gold, we need to understand how the reserve picture has already changed. Back in 2001, roughly 72% of global currency reserves were held in dollars. By the end of 2025, that share was closer to 56%. That is still dominant. The dollar is not disappearing. The dollar is not going to zero. The United States is not going to stop being important, but the trend matters. When the reserve share goes from 72 to 56, you are seeing a slow decline in the dollar's monopoly. That decline does not need to be fast to be meaningful. A reserve currency system is like a giant flywheel. For a long time, it keeps spinning because everyone else is still using it. The more people use dollars, the more convenient dollars are. The more convenient dollars are, the more people use them. That is the network effect. But network effects can weaken. They weaken when the benefits of staying inside the network start to look smaller than the risks of dependence. That is what is beginning to happen. China is central to this. The United States and China are not just competing over trade. They are competing over monetary influence, energy flows, technology, supply chains, and the architecture of global settlement. China does not want to depend indefinitely on a dollar system controlled by the United States. That is logical from China's perspective. So China has built oil futures priced in yuan. It has pushed for more trade settlement in its own currency. It has bought oil from countries that are willing to transact outside the dollar system. It has built relationships with energy producers who want alternatives, and one of the most important developments came when Saudi Arabia, the country at the center of the original petrodollar structure, began selling oil to China in yuan. That matters because symbols matter in global systems for nearly 50 years. The assumption was that oil meant dollars. Then the country that helped build that assumption began showing that oil could also mean yuan. That does not end the dollar. But it weakens the assumption. Then we have the UAE. The UAE has not only been a major oil and gas producer, it has also been one of the countries more open to dollarization and local currency settlement. It has worked with countries like India to explore trade outside the dollar. It has joined broader structures in which countries are trying to reduce dependence on the dollar system. Now, when the UAE leaves OPEC, the surface explanation is about production freedom. OPEC sets quotas. The UAE has invested in increasing its oil production capacity. If it wants to produce more than OPEC allows, then the organization becomes a constraint. That part is straightforward, but beneath the production issue is a deeper monetary issue. If a country wants more freedom over its energy policy, it may also want more freedom over how that energy is priced and settled. OPEC has been deeply connected to the old dollar-centered oil system. The UAE separating from that system creates room for more independent arrangements. Maybe it sells more oil in local currencies, maybe it builds deeper energy ties with China or India, maybe it uses a mix of currencies, maybe it does not make an immediate dramatic change at all. The exact path is uncertain, but the direction is important. The direction is away from a single dollar-centered oil structure and toward a more fragmented system. That fragmentation matters because the value of the dollar depends partly on global demand for dollars. If fewer countries need dollars to buy oil, there is less forced demand. If fewer oil exporters recycle profits into treasuries, there is less automatic support for United States debt. If more central banks diversify into gold or other currencies, the dollar's share of global reserves declines. These are not isolated developments. They are connected parts of one system. That is how I think about these issues. I do not look at one headline by itself. I look at the cause and effect chain. The United States moved off gold. The dollar became fiat. The petrodollar system created global dollar demand. The United States used that demand to borrow and spend heavily. After 2020, money printing and deficits increased concern about dollar debasement. After Russia's reserves were frozen, countries became more concerned about political risk. China pushed yuan-based energy settlement. Saudi Arabia began experimenting with yuan oil sales. The UAE has now moved away from OPEC while already showing interest in de-dollarization. Central banks are buying gold. The chain is clear. It is not a conspiracy. It is a system reacting to incentives. And when incentives change, capital flows change. That is where investors need to think carefully. The first area to understand is gold. Gold has already risen significantly. That means you have to be careful. You never want to chase an asset only because it has gone up. But you also need to understand why it went up. Gold benefits when confidence in paper currency declines. Gold benefits when central banks want reserves that are not someone else's liability. Gold benefits when governments run large deficits and print money. Gold benefits when geopolitical fragmentation makes financial sanctions more common. Gold does not generate cash flow. It does not produce earnings. It does not innovate. It just sits there. For that reason, I do not think of gold the same way I think of a productive investment. A productive investment is an asset that creates value over time. A good business can grow earnings. A good property can produce rental income. A good farm can produce crops. Gold does not do that. Gold is different. Gold is a form of monetary insurance. It is a hedge against the currency. It is hard money in a world where paper money can be created. That does not mean gold always goes up. After the 2008 crisis, gold rose strongly because people feared money printing and currency instability. Then, when it became clear that the system would stabilize, gold fell and stayed weak for years. Gold responds to fear about currency and financial systems. When that fear rises, gold tends to perform. When that fear falls, gold can disappoint. That is why it must be sized correctly. In portfolio construction, the question is not whether gold is good or bad. The question is what role it plays. If you own gold because you expect it to behave like a high-growth technology stock, you do not understand it. If you own it as a reserve asset in a world of monetary debasement and geopolitical fragmentation, you are thinking more clearly for someone who does not want physical gold. There are ETFs that provide exposure to gold prices. Physical gold creates storage and security issues. An ETF creates counterparty and structure issues. Every choice has trade-offs. There is no perfect asset. There are only risks you understand and risks you do not understand. The second area is international diversification. If the world becomes less dollar-centered, then it can make sense to think about assets outside the United States. That does not mean abandoning the United States. The United States still has the deepest capital markets, the strongest innovation ecosystem, and many of the most important companies in the world. But concentration is a risk. If your income, house, savings, stocks, retirement account, and currency exposure are all tied to one country and one currency, you are concentrated. Most people do not think of themselves as concentrated because their brokerage statement shows many holdings. But if all those holdings are United States dollar assets, they may be more concentrated than they realize. International investing can provide diversification. A broad international ETF gives exposure to many countries and many currencies. Developed market funds focus on established economies. Emerging market funds give exposure to faster-growing but riskier economies. Country-specific funds can provide direct exposure to places like China, India, Germany, or other markets. Each comes with different risks. International investing has currency risk, it has political risk. It has regulatory risk, it has different accounting standards, it may produce long periods of underperformance. But diversification is not about owning only what performed best yesterday. Diversification is about having exposure to different outcomes. If global capital flows shift, you want to understand where the flows may go. That is the point. The third area is energy. If the petrodollar system is changing, energy remains central. Oil is not just a commodity. Oil is an input into transportation, manufacturing, food, chemicals, plastics, shipping, and defense. A conflict around oil routes can change inflation. A change in oil settlement can change currency flows. A change in energy independence policy can change capital expenditure. If the United States wants to become less dependent on unstable or unfriendly energy arrangements, then domestic energy investment can become more important. That can benefit energy companies, pipeline infrastructure, refiners, and other related areas. An ETF focused on United States energy companies is one way some investors get exposure. Again, that is not a recommendation. It is a way of thinking. Energy is cyclical. Oil prices can fall sharply. Energy stocks can underperform for long periods. Political pressure can be intense. But when the world becomes more unstable, energy security becomes more valuable, and when energy security becomes more valuable, capital often follows. The fourth area is defense. Many people do not like talking about defense as an investment category. I understand that. There is a moral dimension to it. Every investor must decide what makes sense financially, legally, and morally. But if the world becomes more fragmented, if the Middle East remains unstable, if China and the United States continue competing, if Europe rearms, if shipping lanes become more dangerous, then governments tend to spend more on defense. That is simply how the system works. Defense companies benefit from long-term government contracts. They often have strong backlogs. They do not depend on consumer confidence in the same way many other sectors do. When geopolitical tension rises, defense spending often rises with it. That does not mean every defense stock is attractive. It does not mean valuation does not matter. It does not mean there is no risk, but it does mean the sector belongs in the conversation when you are analyzing a world moving away from the old stable globalization model. The fifth area is still the United States itself. This may sound contradictory after discussing de-dollarization, but it is not. Good investing requires holding two truths at the same time. The dollar's monopoly can weaken, and the United States can still remain the most powerful economic engine in the world. The petrodollar system can fragment, and the S&P 500 can still contain many of the world's best businesses. Foreign central banks can buy more gold, and United States companies can still lead in technology, software, energy defense, healthcare, and financial innovation. Do not confuse a weakening monopoly with immediate collapse. Systems decline slowly. They also adapt. The United States has enormous advantages. It has capital markets that the rest of the world still uses. It has rule of law advantages, even with all its problems. It has entrepreneurial culture. It has scale. It has military power. It has the reserve currency, even if that reserve share is lower than it used to be. So for many long-term investors, owning broad exposure to the United States economy still makes sense. That can be done through total market funds or through the S&P 500. The key is not to panic sell because of scary headlines. The key is to understand the changing environment and build a portfolio that can survive different outcomes. This is where many people make mistakes. When they hear that the petrodollar is weakening, they jump to extremes. They say the dollar is finished tomorrow. They sell everything. They buy one asset. They become emotionally attached to a collapse narrative. That is not how I think. I think in probabilities. I think in systems. I think in balance. A reserve currency transition can take decades. A currency can weaken without collapsing. Gold can rise and still have violent corrections. International markets can benefit from de-dollarization and still underperform for years. Energy can be strategically important and still be a bad investment at the wrong price. Defense can get more government money and still trade at too high a valuation. The right answer is rarely all or nothing. The right answer is usually to understand the mechanism and then diversify intelligently. You want to avoid two traps. The first trap is complacency. Complacency says the system has always worked, so it will always work. Complacency says the dollar has been dominant for 50 years, so nothing can challenge it. Complacency says the United States can print and borrow forever because it always has. That thinking is dangerous because systems change. The second trap is panic. Panic says the system is ending tomorrow. Panic says sell everything. Panic says buy only gold. Panic says the dollar is worthless. That thinking is also dangerous because systems do not usually move in straight lines. They move through cycles, they move through policy responses, they move through reversals, they move through long periods where the old system looks weak but still survives. The disciplined investor avoids both complacency and panic. That is the principle. Look at the facts. The dollar was once backed by gold. It is no longer backed by gold. The petrodollar system helped create demand for dollars after 1974. That system is now under pressure. The United States printed and borrowed heavily after the pandemic. Other countries noticed. Russia's reserve freeze created a risk management shock. Other countries noticed. The dollar's share of reserves fell from roughly 72% in 2001 to around 56% by the end of 2025. China is building yuan-based energy settlement. Saudi Arabia has shown willingness to transact oil in yuan. The UAE has been active in de-dollarization discussions and is now leaving OPEC. Central banks are buying gold. These facts do not tell you exactly what will happen next month, but they do tell you the direction of structural change. And when structural change happens, the most important thing is not to predict the exact date, it is to be positioned so you are not fragile. Fragility is when one bad outcome can damage you permanently. If all your wealth is in cash and the dollar loses purchasing power, you are fragile. If all your wealth is in one speculative asset because you believe a collapse story, you are fragile. If all your wealth is in one country, one currency, one sector, or one thesis, you are fragile. Resilience is different. Resilience means you can live through multiple outcomes. If the dollar remains strong, you can survive. If the dollar weakens, you can survive if gold rises. You participate if gold falls. You are not ruined. If energy becomes more valuable, you have exposure. If technology continues driving American markets higher, you have exposure. If international markets finally benefit from capital rotation, you have exposure. That is how I think about the current moment. Not as a reason to panic, not as a reason to ignore it. As a reason to study the machine. The UAE leaving OPEC is not just an oil headline. It is another signal that the old energy dollar system is becoming more multipolar. The dollar still matters, oil still matters, gold still matters, energy security still matters, defense still matters, American markets still matter, but the relationships between them are changing. If you understand that, you can begin to think like an investor instead of a headline reader. A headline reader asks, what happened today? An investor asks, what system does this belong to? A headline reader asks, will the dollar collapse? An investor asks, what are the incentives of the actors holding dollars? A headline reader asks, should I buy gold right now? An investor asks, what role should hard money play in a balanced portfolio? A headline reader asks, is America finished? An investor asks, how do I maintain exposure to American productivity while protecting against currency debasement and geopolitical fragmentation? That is a different level of thinking, and it is the level people need now, because the world is moving from a single dominant system into a more fragmented system. Fragmentation means more uncertainty, it means more volatility, it means more geopolitical risk, it means more currency competition, it means more need for thoughtful diversification. But it also means opportunity. Capital does not disappear. It moves when confidence moves away from one reserve asset, it moves toward another. When energy systems change, capital moves into infrastructure, production, security, and alternatives. When countries reduce reliance on the dollar, capital moves into gold, local markets, trade networks, and strategic industries. The investor's job is not to be emotional about that. The investor's job is to observe, understand, and position with humility. This is not financial advice. It is a framework for thinking. Do your own research. Understand your own risk tolerance. Do not blindly trust anyone. Do not make decisions because of one video, one headline, or one chart. But do not ignore the structural signals either. Most people ignore monetary history because it feels abstract. They think it has nothing to do with them. But monetary systems determine the value of their wages. They determine the value of their savings. They determine interest rates, asset prices, import prices, energy prices, and the cost of living. When a monetary system changes, it eventually reaches every household. You may not care about the petrodollar, but the petrodollar can care about your paycheck. You may not care about central bank reserves, but central bank reserves can affect your purchasing power. You may not care about gold buying by foreign governments, but if enough governments decide paper reserves are too risky, that changes the price of hard assets. You may not care about UAE leaving OPEC, but if more oil trades outside the dollar, that changes the structural demand for the currency you earn and save. That is why this matters. The ending is not that the dollar collapses tomorrow. That is too simple. The ending is that a system that gave the United States enormous privilege is no longer as unquestioned as it once was. That means investors need to become more thoughtful. They need to hold productive assets. They need to understand hard money. They need to think internationally. They need to watch energy. They need to understand defense and geopolitics. They need to own enough of the American economy to benefit from its strengths and enough outside it to reduce fragility. Above all, they need to stop confusing the number printed on a currency with real wealth. Real wealth is purchasing power. Real wealth is productive capacity. Real wealth is resilience. Real wealth is the ability to survive when systems change. The world is not ending, but the old arrangement is changing. And when the old arrangement changes, the people who understand the mechanics before the crowd does are the ones who make the best decisions. That is the lesson. Do not be complacent. Do not be panicked. Study the system. Follow the incentives. Watch where the capital moves. And build a life and portfolio that do not depend on yesterday's monetary order lasting forever.